This is Alan Bush with ADMIS. In the stock index futures, we are seeing prices lower this morning. In fact, there was some overnight weakness, again linked to the nervousness over the Ebola situation. Also some additional pressure when Plosser of the Fed made some comments that were rather hawkish concerning the possibility of an earlier than expected increase in the Fed funds rate. Since then, we have come back in the indices with mostly better than expected economic reports, including capacity utilization. And jobless claims also showed a rather sizable decline. We continue to feel that although we have all of these geopolitical negatives hitting this market almost simultaneously, that ultimately it will be the new wave of accommodation from central banks that rescue this market. Now, from what low level is hard to say, but with more accommodation on the way, even the Fed, who has been very hawkish in their rhetoric, has changed their tune to some degree, with the exception of Plosser's comments. Even Fed Vice Chairman Fisher, several days ago, making some very dovish comments. In fact, that was over the weekend. So ultimately, we do feel that easy credit conditions will dominate in the stock indices globally. Over in the currencies, we're seeing a very volatile trade with the dollar index, we believe, topping out now as interest rate differentials are no longer as favorable to the dollar index as they had been, especially now with more talk of a delayed increase in the Fed funds rate. However, it is likely that we may see a little more pressure in the Canadian dollar and the Australian dollar as commodity prices remain weak. Still thinking that the best opportunities lie in the interest rate markets right now. There was a very major, what I would call, blow-off to the upside yesterday in what appeared to be a panic short covering rally or a new buying panic, but a very substantial advance yesterday with the long end, the 30-year bonds as much as 5 full points higher at one point, however pulling back later in the day. So any weakness that we see at the long end of the curve, I think, should be viewed as a buying opportunity. I would look for, if we do get a setback of a couple of full points, to be a buyer again in the 30-year bonds. Also, it does look like, even though most analysts are now thinking that the Fed will raise rates in the third or fourth quarters of next year, our viewpoint is that the Fed will not be in a position to raise until 2016 or possibly even later, all of which is bullish for treasuries, especially at the long end of the curve. Once again, these are my opinions alone and are not the opinions of ADMIS or Archer Daniels Midland.